Embracing the thrill, understanding the risk. What equity investments are all about. Investing in the stock market can feel like riding a roller coaster. There are exhilarating highs and stomach-churning lows. But that's the nature of equity investments. They offer the potential for high returns, but also come with inherent risks. Simply put, risk is the possibility of losing some or even all of your invested money. Why does this risk exist? Stock prices fluctuate constantly, influenced by a myriad of factors. Economic conditions, company performance, global events, and even investor sentiment can all impact share values. While these fluctuations create opportunities for profit, they also expose investors to potential losses. Understanding the different types of risk is crucial. Market risk, for example, refers to the overall market's tendency to move up or down, affecting all stocks. Company-specific risk, on the other hand, relates to the performance of individual companies. By grasping these concepts, you'll be better equipped to navigate the exciting, yet sometimes unpredictable, world of equity investing. Remember, knowledge is power. The more you understand about the risks involved, the better prepared you'll be to mitigate them and make informed investment decisions. Let's delve into some proven strategies for minimizing risk and maximizing your chances of success in the stock market. Don't put all your eggs in one basket. The power of diversification. One of the most fundamental principles of risk management in investing is diversification. Think of it like this. Would you rather carry all your groceries in one bag or distribute them across several bags? If one bag breaks, you lose everything in the single bag scenario. Diversifying your investment portfolio follows the same logic. Diversification means spreading your investments across different asset classes, sectors, and geographies. Don't put all your money into a single stock, no matter how promising it seems. Instead, consider investing in a mix of stocks, bonds, real estate, and other assets. Within the stock market, diversify across sectors. Don't just focus on technology. Consider healthcare, consumer goods, energy, and more. Each sector has its own risk-return profile, and a diversified portfolio helps cushion the blow if one sector underperforms. Geographic diversification is also key. Consider investing in both domestic and international markets. Different countries and regions have varying economic cycles, and global diversification can help reduce the impact of a downturn in any single market. Remember, diversification is not about eliminating risk entirely, but rather about minimizing the impact of any single investment on your overall portfolio. By spreading your bets wisely, you create a more resilient portfolio that can weather market storms and deliver more consistent returns over the long term. Historical data shows that diversified portfolios tend to perform better over time compared to non-diversified ones. This is because they are less susceptible to the volatility of any single investment. Consulting with a financial advisor can help you understand the best ways to diversify based on your individual risk tolerance and financial goals. Ultimately, diversification is about creating a balanced approach to investing, one that can provide peace of mind and financial stability. Riding with the giants, blue chip stocks, and market stability. Imagine you're building a house. Would you rather use sturdy bricks or flimsy playing cards? The answer is obvious, right? In the world of investing, blue chip stocks are like those reliable bricks. Blue chip stocks are shares of large, well-established companies with a proven track record of profitability and dividend payments. Think of companies like Reliance Industries, Tata Consultancy Services, or Hindustan Unilever in the Indian context. These companies have weathered economic storms, built strong brands, and often hold leading positions in their respective industries. Investing in blue-chip stocks doesn't guarantee profits, but it does offer a certain level of stability and security. These companies tend to be less volatile than smaller or newer companies, and their dividends can provide a steady stream of income even during market downturns. However, it's crucial to remember that even blue-chip stocks can experience price fluctuations. Conduct thorough research analyze their financials, and assess their future prospects before investing. Past performance is not always indicative of future results. Think of blue-chip stocks as the foundation of your investment portfolio. They provide stability and resilience, allowing you to take calculated risks in other areas. By including a mix of blue-chip and growth-oriented stocks, you can strike a balance between stability and potential for higher returns. Section 4. Staying ahead of the curve. Regular monitoring and portfolio adjustments. Imagine you're driving a car on a winding road. The road is unpredictable, with sharp turns and sudden changes in elevation. Would you keep your eyes closed and hope for the best, or would you stay alert and adjust your steering as needed? The same principle applies to managing your investments. Just like driving, investing requires constant attention and adjustments to navigate the twists and turns of the market. You need to be proactive and responsive to changes. Regular monitoring of your investment portfolio is crucial. It's not just about watching numbers, it's about understanding the story behind those numbers. This means keeping track of your investment's performance, staying updated on market trends, and reassessing your investment strategy periodically. It's about being informed and prepared. Don't just set it and forget it. Your portfolio needs your attention to thrive. How often should you monitor your portfolio? This is a key question every investor must answer. That depends on your investment style and risk tolerance. Some investors are comfortable with frequent checks, while others prefer a more hands-off approach. Some investors prefer to check their portfolios daily, while others opt for a monthly or quarterly review. The key is consistency. Find a frequency that works for you and stick to it. Consistent monitoring helps you stay on top of your investments. What should you look for when monitoring your portfolio? This is where your analytical skills come into play. Track the performance of individual investments, assess your overall portfolio allocation, and identify any potential red flags. Look for patterns and trends. Are certain sectors or companies underperforming? This could be a sign to make adjustments. Has your risk tolerance changed? Life events and market conditions can affect your risk appetite. Adjust your portfolio accordingly to stay aligned with your financial goals. Rebalancing is key to maintaining your desired risk level. Remember, investing is not a one-time event, but an ongoing journey. It requires dedication and vigilance. By actively monitoring your portfolio and making necessary adjustments, you can stay ahead of the curve, mitigate potential risks, and keep your investments on track to reach their destination. This proactive approach ensures you are always prepared for whatever the market throws your way. Section 5. Cutting your losses, locking in gains, stop-loss orders explained. Imagine you're playing a game of cards. You have a good hand, but you're not sure if you'll win. Wouldn't it be great to have a safety net, a way to limit your potential losses if things go south? That's precisely what stop-loss orders offer in the world of investing. A stop-loss order is an instruction you give your broker to automatically sell a stock if it falls below a certain price. It's a risk management tool designed to limit your losses on an investment. Think of it as a safety net that prevents a small loss from turning into a significant one. For example, let's say you buy shares of a company at 100 rupees per share. You could set a stop-loss order at 90 rupees. If the stock price drops to 90 rupees or below, your broker will automatically sell your shares, limiting your loss to 10 rupees per share. Stop-loss orders are particularly useful in volatile markets where stock prices can fluctuate rapidly. They provide peace of mind, knowing that your losses are capped, even if you're not constantly monitoring the market. However, it's crucial to set your stop-loss orders strategically. Don't set them too tight, or you risk selling your shares prematurely during normal market fluctuations. On the other hand, setting them too loose might not provide adequate protection. Remember, stop-loss orders are tools, and like any tool, they need to be used correctly to be effective. By understanding how they work and setting them strategically, you can manage your investment risk more effectively and protect your hard-earned capital. Additionally, stop-loss orders can be part of a broader investment strategy, including diversification and regular portfolio reviews. Regularly reviewing and adjusting your stop-loss orders can help you stay aligned with your investment goals and market conditions. Combining stop-loss orders with other financial strategies can create a robust plan to safeguard your investments. Consulting with a financial advisor can also provide valuable insights on how to effectively use stop-loss orders in your investment strategy. With the right approach, stop-loss orders can be a powerful tool to help you navigate the complexities of the stock market and achieve your financial objectives.